we are here at North Block, and joining us is the senior most bureaucrat here and the man who's involved with policy making, a very important stakeholder in the Indian economy. It's my pleasure to welcome Mr. Rajiv Mehrishi, India's Finance Secretary, right here on ET Now. Thanks very much for being with us, sir. Not a great day to catch up, but a very good day to get your view, and your view matters at this stage, because what we are seeing today on Indian markets, and that's where I'm going to begin, is a crash. In fact, I'm tempted to say it's not a crash, it's a meltdown of sorts. The biggest crash in 7 years, the fourth biggest fall in intraday trade. As the Finance Secretary in the Government of India, how worried are you?
See, if you look at what happened at the Nasdaq on Friday, there was a 500-point fall, and Asian markets across Asia this morning have taken similar kind of declines in their share prices, ranging between 3.5% to 5%. So, in that sense, India's stock exchange decline also seems to be more or less in sync with these developments. So, to that extent, they are not, as long as India is not out of sync with the world, it is not a major cause of worry. And another reason why it's not a major cause of worry is because our fundamentals are in place. So we have our fiscal deficit is in control, our current account deficit is in control, inflation is in control, oil prices are looking southwards. So I think all in all, while it would be wrong to say that one is not at all, one doesn't care what's happening, but at the same time, in India's case, since its fundamentals are strong, I think the situation is not alarming, so to speak.
So that's perhaps a big, that's a big comforting factor, that our twin deficits are under control, inflation is under control. We were seeing early signs of growth. Still, of course, this carnage happened in equity markets. The question I'm asking you is, trillions of dollars of investor wealth today has been eroded in equity markets across the world, and India is no exception to that. What are the factors that you are attributing this global equity meltdown to? Is it China alone, you think?
I think the major reasons are China and the perhaps the consequential decline in commodity prices. So basically, in that sense, it is the worries over China's real growth story. What is the real figure there? And nobody seems to be able to say that with surety, and that is causing the nervousness in the market. So yes, China has had a major role to play in the recent developments in the financial market.
The question that one is tempted to ask, sir, is that because this pain pressure is being led because of China, and because India is a coupled economy in the world now, it's an integrated global economy, are we going to be mute spectators of what's going to happen in the world? I'm sure you've been at the drawing board with your team all this morning. I know that you've been in meeting with the finance minister. What is it that the finance ministry is doing at this stage as this carnage happens?
No. The primary response has to come from the central bank, I think. They look at the currency position and see what they have to do. And they would also have to look at other macroeconomic factors. On our side, the policy response would have to be more, what I might say, calibrated and thought out. So there may be, there may be a need to do several things on several fronts. So I don't think that as of now we have we're in a position to say exactly what we'll do, but obviously government would take such steps. Let me say at this point of time, it's enough to say that government would take such steps as are necessary.
Fair point indeed, sir, and one of those steps will perhaps be to ask your domestic institutions like LIC to step into markets to arrest the fall. Have you made those calls? Have you spoken to LIC to begin investing, to begin buying in markets like these?
No, I don't think that investment decisions should be pushed by the government. It's for the institutions to take a decision. LIC may well see this as a great buy opportunity, I don't know. But basically, I don't think I would disagree with the proposition that we should be pushing any institution to invest against their better judgment.
Fair point, sir. You mentioned a very important point in your previous answer when you said that from a policy point of view, you will be doing multiple things to arrest this fall. You'll be doing multiple things on the policy front to boost investor confidence. Do you believe one of the reasons why this carnage is happening in India, despite our fundamentals being strong, is that the reform agenda has been stalled due to political reasons? I'm not getting into the merits of what the political reasons are. Do you believe that could be one of the reasons why we are seeing very, very deep gashes on the Lal Street?
Well, I have said often enough that in some senses the first generation reforms that were undertaken in 1991 and carried on through NDA regime towards the end of the century are still to be completed. So we still have to look at land, labor and capital.
That's right.
And naturally the stalling of both the land law and the GST has not been in the interest of the Indian economy. So that is the way most I can say. Whether that is responsible for the negative impact, etc., is very difficult to say. Because markets take into account multiple factors, both global and Indian. But certainly it is not. It would have been better if we had, say, GST in place.
Fair point indeed, and one will perhaps see, hopefully see political opposition go on that reform. You know, sir, you very categorically mentioned, and rightly so, that our twin deficits are under control, our inflation is under control. Situation is very different from September of 2013 when we had seen the rupee fall relentlessly. Why is it then the underlying strength of the Indian economy is not coming into force right now? Why is it that investors are ignoring the macro fundamentals that are rather strong and robust?
No, I think the robustness of the Indian macroeconomic factors has been in play for some time now. So, you know, you would have noticed that Indian rupee was actually holding up very well against currencies other than the dollar.
That's right.
It was also its stock prices are also doing better than most other economies. So therefore, to say that it's not held up is not good enough. But if you have a massive sort of decline across the globe and great doubts about China's real growth, then obviously India being a player, very much a player in the global field, can't remain unaffected.
I want to shift focus now to the rupee because that is really the big talking point right now. It has depreciated relentlessly, but many people believe it had also appreciated a lot, and the government and the RBI had not intervened at this stage. I'm going to ask you a very contrarian question. Do you believe the fall in the rupee is actually welcome at this stage, just to boost the competitiveness of our exports right now? Or do you believe the rupee is relentlessly falling and the RBI, I'm going to speak to the RBI in just a bit, but the rupee per se first.
See, I just told you that the Indian rupee had hardened in the past few months against the other major currencies, including yen and euro. So to that extent, some adjustment would certainly help exports. But again, you know, these are things that are impossible to put a figure to. So India has followed the path of letting its currency be governed by the markets since 1991, and I think that's how we should look at it, that we should let the market find the real value of the rupee, and rupee find its own value in the market, rather than, you know, saying that it's fallen below this figure or that figure. There can be no figure for the rupee. The rupee must remain competitive, but it must still remain stable. And it should not be very volatile, because any volatility will hurt every facet, including exports. So extreme volatility is also not exactly good.
That's right.
But at the same time, any excessive interference in the market or holding the rupee up against other currencies is also not good. So I think again a very balanced approach to the rupee, which is to let it find its own value. And to prevent and to intervene only when there is major failure, so there are major market failures, so there is major movement, is the most balanced approach you could take to the value of the rupee.
And that's perhaps what we mean by free market. The question that I'm asking you is, rupee of upwards of 66, does that warrant intervention? Because the RBI governor earlier today said that we've got reserves worth $380 billion and they will play with it when warranted. The question that I'm asking you is, isn't the time right to play with those reserves right now?
See, that is a call that the RBI is required to take. I should not prejudge RBI nor try to influence its decision. So it's for RBI to take a call on whether they need to intervene at this stage or not. But I must reiterate and say that talking in terms of saying that since rupee is 66.80 now or 66.60 now, now is the time to intervene. That's not the right way to look at it. The right way to look at it is that how you are faring vis-a-vis a basket of currencies.
That's right.
And how much you are in sync or out of sync with what is happening to other currencies and other markets. So I think it's a much more subtle exercise than just looking at a bland figure and saying that it's not acceptable below this figure. That would be too crude a way to sort of approach it, and I'm sure RBI will take a very nuanced approach to this.
Fair point indeed, and in consultation with all you policy stakeholders here, I want to shift focus to crude oil, and one of the reasons why the world is in a panic mode is because of the commodity crash that one has seen. I mean, NYMEX is down $40 a barrel, in fact even levels below that. Does this crude crash somewhere as the finance secretary bring a smile to your face, because you're also getting into budget making? It does bring a certain amount of comfort, or does the concern surmount the comfort that it's bringing in?
No, one has to again look at it from both ends. You know, to the extent that it depresses global demand, and to the extent that it reflects a slowdown of a major economy like China, which is indeed a major world economy today. Obviously, it is also a cause of concern. Of course, the dollar, I think the crude oil prices in 3 figures were much too high for any developing country to sustain. And therefore, to that extent, the reduction in the oil prices from reasonable levels is more than welcome for us, and it has really helped the Indian economy stabilize. It has helped Indian economy's current account deficit, it has helped India's inflation. But one wouldn't want to say that any decline up to any extent is always going to be good for India.
That's
so
right.
We need to look at it from both ends. So it has been good, but to the extent that I said it reflects China's weakness, it is a bit of a worry.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.